I'm excited to turn it over to my colleague, Ray Krause, who's going to introduce our next speaker. Ray, the floor is yours.
Thank you. Hi, my name is Ray Krause. I'm a principal at Sikich, and it's my pleasure to actually introduce our next speaker. I've known Julie for quite a while. Julie is the Vice President for Finance and Administration at University of St. Francis, and she brings a wealth of knowledge both in the higher education field and spent some time prior to that actually in the corporate world as well. More recently, Julie has obtained her doctorate in Doctor of Education, Higher Education Management, and that'll really lead into the presentation. I know her part of her dissertation was based on what she's going to speak about. She has a wealth of knowledge in this area. So at this time, I'd like to introduce Julie Gard, who's going to take us in our next presentation on the predictive power of key financial metrics and exploration of financial viability for tuition-dependent institutions. So thank you, Julie. The floor is yours.
Thank you so much, and I appreciate everybody's time today. Welcome, and thank you very much for inviting me. This first slide to kick off this presentation, there's absolutely zero surprises on here for any of us that are in higher education at this point in time, but just really to level set what encouraged me to ultimately do the research I did and be excited to share with you today. Are just all the headwinds that we're seeing in higher education, not only private, as my slide says, but from a governance perspective, we can all understand the fear of difficult decisions being made. I hear it often, not only at my own institution, but at other institutions that I've been doing some consulting work for as well. We've been through worse. We'll get through this. This concept of problem blindness, either it's impacting everybody else or it's really not that bad here. I was just at a conference this past weekend and the president of an East Coast institution was sitting next to me and he said, for everybody talking about we need to do something now, especially with these smaller private institutions, he said, I haven't talked to anybody in here that said their institution is not doing just fine. So certainly problem blindness. Shared governance, does it always help or can it be a hindrance depending on if it's weaponized or how that is going? And then I hear very often, not my problem, budget, actuals, none of that. That's the CFO's problem. And then we all know the realities on the financial side, especially for those of us at tuition-dependent institutions, the risk of the potential enrollment pool dwindling down the road. We know the financial pressures associated with higher education for the folks that we're hoping to recruit. I know as well as my own institution, the lack of non-tuition, non-room and board, not complete lack, but certainly not abundant sources of those as well. So diversification concerns. Liquidity, and just to level set here by liquidity, I mean the ability to convert anything to cash in the short term. Higher discount rates as we're all seeing, and then certainly labor and non-labor expenses going up faster than what we're able to necessarily add to the tuition component. So all that being said, I was very interested in looking at the current, what I'd call financial viability models that are out there in the industry that we all use in various ways, shape, or form, trying to understand really the nuances between them and what were the benefits or not in utilizing those to assess really the financial health, or what I'm suggesting, the financial viability for the institution. And then I wanted to look more deeper and understand if there were certain factors, or what I'm going to call components during the rest of this presentation, that really are more impactful in understanding and assessing an institution's financial health. And really, is there any predictive value of potential closure based on those factors? So my hope today is that you'll learn about another financial viability model that's available for private higher education institutions, and then take away some of the key factors or components, if you will, that really seem to have the most significant impact on financial viability for schools. So we're going to spend a lot of time in this slide, and I'm going to start on the right-hand side of it, if you will. So my focus in doing my doctoral work at the University of Pennsylvania was first to understand what models, if you will, are out there to assess the financial health of universities, and why aren't folks utilizing it more? Why aren't the non-financially savvy folks either well-versed in it or able to utilize it? And by non-financial savvy, I'm suggesting board of trustees, other key constituents, even the president or other cabinet members other than your CFO. So looking at the ones that are out there, and please note, I am not trying to find fault with these. They're just different, if you will. So the first being Robert Zemsky's market stress test. His book came out in 2020, talking about how schools could assess or calculate their financial health through this stress test concept. And what he is doing is looking at IPEDS data first, looking at trailing 8 years of IPEDS data, but in 4 key areas. So as I talk about this, I'm talking about either ratios, component calculations that would fall into like a liquidity category. These are the rows in my matrix on the right-hand side. More of an operational results category, or other, doesn't fall into a liquidity or operational. The check marks in each of these boxes represent the number of calculations, ratios, component pieces that make up each of these areas. And then the percentages represent the weightings for each. So taking a deeper dive into Zemsky's market stress test, I might add he was on faculty at the University of Pennsylvania. So I took a chance in researching and suggesting something slightly different from his published work. But nonetheless, his book, Market Stress Test, talks about 4 calculations, one being the change in the number of first-time, full-time undergraduates over an 8-year period, again, utilizing IPEDS data. The second calculation being first to second year retention rates. The third being understanding the change in the average net tuition paid for a new undergraduate. And then the final calculation being looking at the value of the endowment in its entirety, so both with and without donor restrictions, as a percentage of total expenses. The theory behind this is for each institution, when you look at the trailing 8 years of these data points through IPEDS, and then project out 3 years from that. The idea is the past is a predictor of the future. The challenge I would suggest right away is by looking at IPEDS data 8 years prior, the most recent IPEDS minus 8 years, you're already several years behind, as we know. Nonetheless, you calculate this for your own institution. At the same time, then, this analysis analyzes that similar calculation for all, so in my home institution's case, all private 4-year not-for-profit universities. Well, that number isn't automatically calculated every year. So I will admit I tried in 2022 to calculate my home university's market stress test calculation, and then I needed to calculate it for all private 4-year nonprofit universities. I did. It was Herculean, and I don't think I'm ever going to do it again. So what this then does is looks at the 4 component calculations that I mentioned, analyzes the university's calculation, and then relative to all the universities in that subset. So in my institution's example, that was private 4-year not-for-profits. It's like golf. You want a score of a low score is better, and you get points towards your score, ergo not positive, if your university's trend is going down or going down relative to all of the universities that you looked at in your population. So useful, accurate, I'd say somewhat, virtually impossible to recalculate year after year. And then again, the reliance on what I would suggest is stale dated IPEDS data. So I wasn't happy with that. Then if you look at the Forbes College Health Grade, they just came out with their new grades this year. Those are issued an academic grade, if you will, of a letter A through D, no Fs. It's issued every other year, starting in 2013, I believe is the first time that Forbes issued these. And there's two of their component calculations that I would deem to be liquidity related, which accounts for, I believe, 25% of the overall calculation. 4 that pertain to more operational type metrics, if you will, like viability ratio, primary reserve ratio, et cetera. That accounts for half of the weight overall. And then 3 that I would consider other, such as admission yield information, percentage of first-year students receiving institutional aid. If that's a higher percentage, my institution, that's a very high percentage, and we're proud of that. You get penalized for that in the Forbes index. And I say, I believe, or I'm estimating these weights, their rubric changes every 2 years when they do this, and they don't give you the full information on the rubric, not so much to audit them, but I wanted to understand maybe where my institution was being dinged or how we compared to prior years. The rubric changes and you never get the total, the clear picture. You just see your grade out there. So again, I was frustrated with that. The composite financial index, we all know this one well. There's 4 ratios that make this up that are weighted accordingly. Again, utilizing IPEDS data. So I would suggest somewhat stale dated information. And then we also know, based on when the actual CFI number, index number, if you will, is calculated, and it can be anywhere from a -4 to a +10. There's 9 different categories that are provided to help define. So, for example, a score of 1, remember from the range of -4 to +10, a score of 1, the CFI strategy associated with that score is re-engineer the institution. A score of -1, the CFI strategy associated with that is consider substantive programmatic adjustments. So helpful perhaps, but ominous absolutely, and is that really actionable, I guess, if you will, certainly across all key stakeholders within the university, or is that truly understood by the board, by senior management, et cetera? The last of the calculations that we're all aware of and is included as a footnote in our audited financial statements is the Department of Education's financial responsibility score. So again, not knocking this score, but as we all know, the end result of that calculation results in a numerical answer of anywhere from -1 to +3. There's 3 different categories that an institution should fall into. I should note we're not using IPEDS data in this one. As you all know, it's your audited financial statement data, which I suggest is much more relevant and timely. But from a board's perspective, or key stakeholders, or even just your cabinet level's perspective, does that 1.7 or 0.6, what does that mean going forward? I understand that whole computation is based on looking through everything through the lens of being able to continue to provide Title IV or participate in Title IV funding. So certainly helpful to put universities in those different categories, but I would suggest not overly helpful to an institution or to a key stakeholder to understand or appreciate there's an issue, maybe what should we do? So if you look at the left-hand side of the screen, then what I was ultimately ended up doing is creating something that I'm calling the Financial Viability Index. I have identified 8 different what I'm calling components, or either calculations or dollar amounts or percentages that come right off the audited financial statements. What they are, and you'll see I have them on the screen on the left-hand side. 4 of the 8 I'm identifying as liquidity measures, and the other 4 I'm calling operational measures. You'll see it obviously foots to 100%, but the total index value is actually 100 points. So for example, net tuition revenue, that component has a 10% weight, thus the max score an institution could receive is 10 accordingly. So just to level set on what these components are, net tuition revenue is exactly what you know it is to be, gross tuition minus the financial aid discount. This is in total. I'm not looking at it per student at all. This will highlight, by looking at the total dollar amount, if your increase in your gross tuition, your tuition rate, ends up being cannibalized by total discounts being offered. So again, looking at it in total, right off the financial statements, not per student. Student revenue coverage is maybe a little bit more unique way of looking at it. It is, or a variation of this student revenue coverage concept, is one of the components that's utilized in, I believe, in the Forbes College Health Grade Assessment. But what I'm defining student revenue coverage, especially coming from a tuition dependent institution as I do, is looking at net tuition revenue plus room and board revenue. So starting with all student related revenues, if you will, minus total operational expenses. How well do those student related revenues cover our total operational expenses? We at my institution do our best to budget for this to be a break-even calculation every year for us. What that does is allows investment income and fundraising dollars to help us budget or for strategic initiatives, if you will. We wouldn't do it otherwise if we didn't call it out this way. But I'm using the student revenue coverage concept in my financial viability index because honestly, going into this research, I thought that was going to be the most pivotal component of all of this. I'll tell you at the end, it didn't end up having as much weight as I thought it would. Still important nonetheless. Cash flow from operations, very clearly that. The subtotal within your statement of cash flows. Again, if you're not generating cash flow from operations, yet you still have positive cash year over year, a positive cash increase, that means you're either borrowing to get additional cash in or selling investments. So this is really focused on operationally, are you bringing in positive cash flow? And then the last liquidity measure being earnings before interest, depreciation and amortization. I'm really looking at the cash earnings, if you will, generated by the university doing its core work. So if you're doing the math in your head, you'll see that these 4 liquidity related components of my financial viability index sum up to be 55%. So I went into this truly believing that liquidity was ultimately at the core of all of this for especially these smaller private institutions. Excuse me, I didn't mean to advance yet. And this calculation then supports that as well, with just slightly over half of the overall weight of this index calculation being focused on liquidity related measures. From an operational perspective, I'm pulling in the unrestricted portion or without donor restrictions portion of the endowment, and I'm showing that as a calculation versus or a percentage of net tuition revenue. I appreciate the two are not correlated, and this is not a calculation that you're normally going to see elsewhere, but this ratio I felt will be negatively impacted as institutions borrow from their endowment or spend from the endowment in excess of their current earnings, which we know is going on, and now we're reading about this all the time. and also shows as net tuition revenue or total revenues, if you will, end up to have more, be less focused on just net tuition revenue or room and board revenues. I think you'll see that denominator not having such a huge impact on this. So this was a unique calculation, but ended up being a very important one as part of this process. Viability ratio, exactly what it is in the CFI. It really is assessing the abilities, institutions' capacity to take on additional debt. Primary reserve ratio, again, same as what we saw in the CFI. That assesses the institution's ability to cover 1 year's worth of expenses, or how much of 1 year's worth of expenses they're able to cover from unrestricted or without donor restrictions earnings. And then finally, return on net assets, exactly what we would understand that calculation to be. So that is the what behind the financial viability index. If you can bear with me, I'd like to go into a little bit more of how the sausage is made, if you will, behind the scenes. So remember, the entire index scores we mentioned was 100. The best score is 100, the worst score is 0. I have not seen an institution in all the, I think I've calculated this for 426 institutions so far. Nobody's 100, nobody's a 0. Nonetheless, for each of those 8 components that we just talked about, there's 2 pieces of the score that feed into that overall, what could be a 100 point calculation. There's the value component. So the dollar calculation, percent calculation, whatever it might be for those 8 different components. There's a value, or points are awarded, more points if it's a high value, fewer points if it's deemed to be a medium, and then even fewer points if it's low. How did I determine what was high, what was low? I had been doing these type of ratio analyses for it was close to 400 private schools using Federal Audit Clearinghouse data. Again, I've never used IPED's data in any of this. It's access to the uploaded audited financial statements in the Federal Audit Clearinghouse. I had been doing this for years for well over 400 schools. I had defined my high, low values based on the schools that were in the 75th percentile, schools that were in the 25th percentile. That was where I drew the line at high or low. And then arguably in that interquartile range, that middle 50%, that's where the medium value came from. So that's the value component of the score for each of those 8 components. Then there's a trend component looking at 3 years, the last 3 years of this calculation based on audited financial statements. If it's an increasing trend, points are awarded. If it's a decreasing trend over that 3-year period, points are deducted, again, for each of those 8 components. High level of the total 100 points available, roughly 80% pertain to the value calculation, point in time value as of that end of the fiscal year, and roughly 20% pertain to that 3-year trend. So based on the score, again, best being 100, worst being 0, I've stratified it into and then tried to color code it to make this almost like a heat map, if you will, if you're trying to assess several organizations at the same time, or even year over year for a particular university. Blue being the best, roughly schools that are in the 90th percentile for my financial viability index calculations are blue, and then down to green, yellow, orange, and then those that score below 35, roughly the lowest in just the 20th percentile financially from this calculation, are red. I do want to note, and I'll say this again, but an individual scoring in red multiple years, one time, this is not meant to be a predictor of closure. So I've been trying to be very clear as I've talked with folks about it. This is just another way to assess financial viability. What I'm hoping is that schools will understand the trend in their calculation. So last year, for example, a school was yellow. This year, they're red. Why? Well, maybe it's because every single one of those components ended up decreasing over the 3-year period. Okay, that doesn't mean the end is coming. The key is understanding the why and then doing something. So this is the ultimate logic behind how the calculation came to be. Again, 55% of the overall weight of this has to do with liquidity, which is, I believe, the name of the game, especially for these smaller private schools. So now we've determined how the financial viability index is constructed. What did I do? How did I ever come up with 125 pages to write about it? This pure CPA it was challenging, let me tell you. But what I did, my interest was in looking at the changing colors, if you will, for particular institutions. Is there a probability if you start per the financial viability index calculation, if you start in blue, for example, are you more likely to change to some other color or stay the same? Similarly, if you start in red, are you doomed to always be in red? So the way I looked at this, I utilized something, a concept called a Markov chain, which is the probability of going from one state to another. I actually reached out to the Council of Independent Colleges, that group, and was able to obtain their member list. And I thought I knew I was interested in private universities, and by definition, their membership list would be just that. So they graciously provided me their member list, for which they have stratified in 4 different buckets based on full-time student FTE. So I took the bottom 2 buckets, if you will, or the smaller schools within the CIC member institution list, and those would have been schools with 2,000 or less student FTEs. I then went and ended up being 379 schools. I calculated their financial viability index, again, using their Federal Audit Clearinghouse financials. So those of you that have gone through doctoral programs before, I had 0 IRB issues, because I had no public or private information, if you will, and no human subjects. So it was wonderful. And then this chart here, focus more on the middle left-hand part, is really what resulted. So let me explain to you how to read this. Of the 379 institutions I looked at, 40% started in blue and ended in blue over the 4-year period that I was analyzing them. So that's the top left 40% number you see, start in blue, end in blue. You could read this similarly, 41% of those that started in blue ended up in green over that period, etc. So looking at the far right-hand side now, to summarize it all, and this I just find absolutely fascinating, to be honest with you. So if you see, obviously, if you start in blue, you're 58% likely to deteriorate, or more likely to deteriorate. It does make sense because there's no place to go up from blue. But 40% did start in blue and remain in blue. If you go all the way down to red, more than half of those that started in red stayed in red, but encouraging, I thought, to see 47% improved. So being in red, like I said earlier, is not necessarily the death knell is ringing. Certainly does not mean, better not admit a class next year, but it does mean look at things. I have all kinds of examples in my research in the dissertation where I did look at schools that improved from red. It is possible. Interesting to note, I thought, as well, as those schools that started in orange, you were just as likely to improve or deteriorate, each with 36%. No other starting in color had that same result. So I thought that was very interesting as well. I had initially moved forward with this with only 4 colors: green, blue, green, yellow, red, and a retired president at a university on the East Coast that was helpful in helping me think through this and allowed me to do my pilot study on his institution, amongst others, reached out and said, you need something between yellow and red because so much is going on with these schools. So I certainly appreciate that. I did receive information that there was a question in the chat regarding that student revenue coverage calculation. And I'll just stop here and I'll reiterate that because I know it's different. You're not going to find that in a textbook or literature. And it is a key underpinning here for private schools. The definition of that student revenue coverage is net tuition revenue, dollars in total, plus room and board, dollars in total. So those two combined, what I would say are your student-related revenues. That minus total expenses. That will end up with a total dollar amount. Ideally, it would be break even, but in just about every school, it's negative. My FVI index is looking at how negative is that, but it's a dollar calculation of student revenues minus total expenses. Yes, I include depreciation expense in there. I get asked that all the time. I understand it's non-cash. That is the calculation. And like I said, my institution, we have done our best to try to budget to that being a break-even number, just because we know we are tuition dependent. I'll tell you, if you do that calculation for a Notre Dame or for a University of Pennsylvania, which is where I got my doctoral degree from, it's going to be a hugely negative number. And that's okay, because they know that they have a sizable draw that they're able to make from their endowment to fund operations. My home institution, we don't even draw from the endowment for operations. We want to keep building it up. We draw to support scholarship spend, but we don't draw to fund operations. So that's why that student revenue calculation or coverage calculation is vital, I believe, for smaller, not well endowed, tuition dependent institutions. Nonetheless, going back then to the results of the research in my dissertation of the 379 schools, it was fascinating. You might be asking yourself, because I did all of this research during 2022, 2023 timeframe. What did I do with COVID, with the HERF funds, which is a common question. For institutional HERF funds, I did nothing with those. I let the revenues come in as part of the overall total revenues of the organization, and any spending that was supported by those funds coming in institutionally, I allowed those expenses to stay in, like any other grant, if you will, that the university had received. What I did, though, is for the pass-through, for the financial aid component, of which we were basically the pass-through entity to provide that to the students. And now we're required to show that as HERF revenues coming in and then a financial aid expense. I've pulled those out of any net tuition revenue calculations, any total revenue calculations, because we were just that, a pass-through, a conduit. It was not a deterioration of the institutional aid percentage. So I did pull those out based on the federal schedule, summary schedule in the back of everybody's audit report. So now that we understand what it is and how it came to be, I have sensed this honestly has been a labor of love for me. So while my current president wasn't too keen on me continuing this research on all 379 institutions, I have on my own time watched, as we all hear, what is going on in, again, this is the private higher education space. since I defended. This schedule that you're seeing here, when I defended my dissertation in April of 2023, we were looking at 30 some odd institutions at that point in time that had closed. Now I've continued to track this as this is current through December 30th of 2024. So starting with all private higher education institutions that have announced their closure since fiscal 16. And the reason I'm saying fiscal 16 is the Federal Audit Clearinghouse database. We were first required to upload financials there starting with fiscal 16. Many of us upload comparative 16, 15 numbers, but really the safest starting point for me in all this was fiscal 16. I backed out of those 124 institutions. I backed out ones that I couldn't find zero information at all uploaded to the Federal Audit Clearinghouse regarding their audited numbers. For schools that are no longer open, either due to a merger or acquisition, I've taken those out because I don't want to assume that that only happened because they were in financial distress. There were 2 schools that as were part of the 124 that closed because a particular branch closed, but the rest of the university stayed open. I excluded them. One of the 124 no longer issues degrees. Okay, I'm going to back that out. And then finally, there was one institution that closed early on back in fiscal 16, 17 because of institutional fraud regarding payroll taxes, et cetera. I thought I'm going to pull them out because how their financial viability index calculates, I think I need to take that with a grain of salt. That leaves 62 institutions for which I could find information on the Federal Audit Clearinghouse that have closed back to fiscal 16 through the end of last calendar year. So what I've done with those 62 institutions is I went back to the earliest date up through the most recent date that I was able to get or obtain their financial statements through the Federal Audit Clearinghouse, and I calculated the financial viability index. So this was, and again, I stopped at Finlandia, so kind of a little bit further down than midpoint here on this screen when I actually defended, but I was trying to answer the question, is there some predictive nature of a school being in red ultimately closing? Not necessarily. Like I've said before, just because a school calculates red does not mean that closure is imminent. But looking backwards at those who have closed, so they already made that decision, calculating this up until the point of closure, 53 out of the 62 schools, or over 85%, were red prior to closure. Just shy of 10%, or 6 of the 62, were orange prior to closure, and then 3 were yellow. I've had a dozen people say, well, what about those 3, just shy of 5% of the 62? Did they close too soon? And I said, no, that we're only looking at, or my source of information is what has been uploaded to the clearinghouse. So, it very well could be they're still working on that, the current audit that probably will calculate out that they're orange or red. So this is not meant to tell a university when to close. B, it is not a predictor of closing, but probably the most important takeaway for this, from my perspective, is being red, a school is 17 times more likely to close than a school that's yellow. And then similarly, being red, a school is twice as more likely to close than a school that's orange. Moral of the story is schools need to do something if, as I said before as well. The other piece that I was very interested in understanding, and this is research, if you will, that I've continued even post completing the dissertation and having it published. But in looking at the 62 institutions, like we just noted, that had closed, for, and we saw the reasons that I pulled schools out of that mix, but legitimately closed post fiscal 16. What you're seeing here is the average score per the financial viability index for each of the 8 components for the 62 institutions. So maybe looking at the top here, the 3 institutions that were yellow upon closure or immediately prior to closure, the average net tuition revenue score of that component, that does not mean they had $2,000,000, whatever dollars of net tuition revenue. That was the score, but the trend and the value component of that score in the FVI index, their average score was 2. Cash flow from operations, average score was 4. EBITDA 4. Student revenue coverage, remember student-related revenues minus total operating expenses, was still high. I was shocked for really all the institutions, certainly the 3 that were yellow upon closure, the 6 that were orange upon closure, even the 53 that were red upon closure. Student revenue coverage was still relatively high. Those first 4, net tuition revenue, cash flow, EBITDA, and student revenue coverage, I have that bracketed because remember those were the 4 component pieces that I was saying were liquidity focused. And my assumption going into this is that after closure, every single one of these in this blue box here would be super low scores. So I was surprised with the student revenue component piece. Looking outside of that box, we're seeing the average score based on schools that were either yellow, orange, or red upon closure for return on net assets, unrestricted endowment as a percentage of net tuition revenue, viability, and primary reserve ratios. So the 4 that I have a green check mark above, primary reserve ratio plus 3 of the 4 components within our liquidity family, those had statistical significance in explaining the variance in an FVI total score, or why one changed year over year, ultimately prior to closure. I thought this was fascinating. So it does show us that there are statistically significant components or metrics that do weigh in determining really what did a closure look like, what was the anatomy of the schools that closed. It's low net tuition revenue, again in total, not per student. It's low or extremely negative cash flow from operations. It's low and in many, many cases negative EBITDA. And then the low primary reserve ratio. And remember that primary reserve ratio is the portion of unrestricted or without donor restrictions net assets that are able to cover a full year's worth of expenses. Those numbers were getting very low. I found it interesting too that the schools that were red prior to closure scored even worse on the primary reserve and even on the viability ratio than the orange schools. That seemed to be the last tree to fall for them, if you will, that they had no ability to take on additional debt, being a low viability score, and then they really couldn't cover much of any of the year with being able to cover expenses using their unrestricted net assets. So many schools ended up with a negative unrestricted net asset number. So that is the construct, that is the research that was done. And really my most important takeaways for this, it's not too late for institutions to make changes. It really isn't. That's why, honestly, this FVI calculation utilizes a 3-year trend. I've had people ask that, well, why not just 2 years, or why have that trend piece in there as well? Because it can have cause fluctuations and the resulting score, the resulting color, even just based on that every 3-year trend that's going on. My opinion was, well, 1 year is not a trend. I didn't want the extreme fluctuations just based on a one point in time calculation, just using the data from the current fiscal year audited financial statements. And I believe 3 years should be ample time to make some changes, right? And hopefully to see the positive impact of those changes. The other key takeaway for this, and I'm seeing this all too often now as I continue to update these FVI calculations, we're seeing more and more schools borrowing from their endowment, moving to an interest-only debt payment, or even drawing more from the endowment than their calculation does allow. And I would just, and I'm preaching to the choir here, I understand, but we need to be clear with our own institutions and those we're working with to understand that is not the path to financial health, to financial viability. So it's not too late. This calculation is just another metric or hopeful tool out there that can be used. And the endowment borrowing does seem to be a slippery slope that so many institutions appear to be utilizing, and I do caution from that.
Julie, you mentioned a couple of things that I wanted just to kind of revisit, in terms of, the institution, your boss at the institution, in terms of kind of, not continuing to gather this data and do that, and spending some time. Certainly, I mean, it's fascinating from my standpoint to see the level of detail that you were able to go into, and what those findings entailed. If you were to kind of look back at this, is there anything, additional or any other components that you would, factor into this that, maybe were considerations but didn't kind of make it into your overall analysis?
Excellent question. If I had to do it over again, I would certainly factor in differently institutions that have loans taken out against their endowment. As we all know, that doesn't show up on the face of the balance sheet, right? You don't see that at all, because typically it's shown as a due to, due from, due from the university, due to the university's endowment fund. And you only see it in a footnote. And just because I'm not doing any of this during work time doesn't mean that this isn't how I spend my nights and weekends. I'll be completely honest with you. I'm fascinating at digging into that more, that what is buried in the endowment footnote for so many of these institutions, because I do believe that that's a very slippery slope. And to a certain extent, it's a gateway drug, to be honest with you, because once they start drawing, and know an institution, I was just meeting with their president, 2 years in a row, they've drawn from their endowment, haven't made that clear to their board, because I don't think anybody on the board has read the 52-page audit report. Unconscionable for those of us CPAs out there that live for these audit reports. But I feel that's not a good path to be going down. And if I had to do it over again, I would have calculated that somehow, or factored that in.
No, that makes sense in terms of looking at that, right? And I think it's interesting as we look at the audience of the folks that are in the session today, and the different types of institutions that you face there, right? And the different institutions represented for that. To your point, the smaller nonprofit institutions, and that need to be able to tap into those amounts, and what does that sustainability look like when you factor that in there, on some of the, schools that, whether they be the community colleges or others who saw a much larger, influx from HERF and the ARPA funding in terms of that. I think there's so many different variables and different types of, streams from a revenue standpoint that could impact some of these considerations, as someone maybe looks at this and says, well, how do I apply this to my organization there? And quite frankly, I think probably, the you know, I think a lot of folks, whether it be borrowing from the endowment, whether it be some of the, grant funding, things of that nature there, it's interesting to see just kind of, is that being used as a Band-Aid or something that kind of pulls the wool over someone's eyes there to paint maybe a bit of a rosier picture than actually exists. For those of us in Illinois, you watch at the state level there in terms of the funding there, and I've been sounding this alarm with our clients for some time there, is that with all the additional federal dollars that came in over the last several years, it paints one picture, but what does that look like when kind of the free money dries up, if you will, in terms of that? So had a couple questions here. These might be I'll start with the one that I think is more answerable, because it's just would you like to see any changes to the DOE's composite score? Any perspective or any thoughts on that from your perspective?
Well, I need to be careful, I guess, what I say, but if the purpose of that calculation is purely through the lens of institutions able to participate in Title IV funding, and in a certain range, make sure you don't stay in that certain range for 3 years, and if you're in a lower range, provide a letter of credit. I think for that purpose, it's fine. Like I just said, I didn't think it was helpful for me to be able to really assess, benchmark our financial viability or benchmark against other institutions. Once, I don't know how many years ago it was, but once Ray told me about the Federal Audit Clearinghouse, I've been in it nonstop. And to me, it's that Department of Ed's calculation isn't helpful for truly assessing the financial health and viability of an institution. So,
nope, I think that makes sense, and I think, like you said earlier, the reality is the most timely data that you're going to be able to find in most cases is that information out on the clearinghouse website there, and for as many challenges that the new site has provided as part of that, they're working through those things. So it does seem to be pretty useful in terms of being able to pull a wealth of information and kind of have a pretty robust data set to be able to pull from there. The other question we got here is, and this one you can certainly kind of punt on if you so choose. It says, do you expect discount rates to continue to increase with the COVID student funding discontinued? It's a tough one. That's a crystal ball one, right? But
it is. But I mean, even just last year, what we were all dealing with the FAFSA debacle, I know schools that I've been intimately involved with. So I'm functioning as a fractional CFO for another institution as well. We did see significant pressure, the discount rate increasing, because I think everybody led at the last minute with their best offer to these students. I don't see that necessarily improving. The students are much are savvy consumers, if you will, of this, and looking at price, and I don't see that in necessarily improving, unfortunately. The other thing I do want to note, I know I didn't show you how to actually do the calculation. The dissertation is public, and all the information is in there on how to do this calculation for your own institution. So that is something that if you're interested in trying to calculate this for your own institution or for others, that information is out there. So I wanted to make sure that was clear. I get no money from this at all.
So like you said, a labor of love, right?
It is, absolutely.
So Julie, this was phenomenal. Thank you so much for your time and your expertise and sharing the information on your dissertation and just, again, a fascinating topic, and spending time with our group this morning to share this information.